Good morning, everyone. It's Melanie Goodhue here, owner of Pulse Wealth Management. With all the craziness that's happening right now with COVID-19, I wanted to check in and ask how you're doing. How are you doing? Do you need anything? If you do, please send me a private message. It'll remain completely confidential, and I'm more than happy to help you. I know I'm definitely not the only one offering help. It's actually incredible to look out onto Facebook and see all these support groups that have formed and all of these people who've made posts to extend help where it is needed. So please, if you need help, please reach out. There are so many people more than willing and happy to help. Now to talk about the financial markets. How are you feeling about that? It's no secret that the markets have taken quite a hit in the last couple of weeks. Let's put COVID-19 aside for a second. Market volatility was inevitable because just how economic cycles go, we had the longest bull market in history of about 10 years. That is unheard of. A bull market is a steady increase in markets over a period of time, and 10 years is a really long time. So we were due for some sort of volatility or crash. Now, COVID just happened to speed that up a little bit. I'm jumping on here to talk to you about why it pays to stay invested. Now, I'm specifically talking about segregated funds and mutual funds and pooled funds and that stuff like that. But this also can certainly apply to things like the stock market. And the example I'm going to show you today is actually based off of the stock market. Nobody has a crystal ball. Okay, that's really important for us to understand, is that even the best portfolio managers in the world can do their best to try and predict what life events and what things happening around the world are going to affect the market. But there's absolutely been lots of times in history where, they predicted it would go one way and it actually went the complete opposite. Trump being elected was one of them. Everyone predicted a fall, and actually markets went up. So the message here is, if the most successful portfolio managers in the world don't have a crystal ball and they sometimes get it wrong, then you certainly should not be playing God and trying to, read this crystal ball and time the market. I want to show you a great example today of why staying invested, even in times like this of high market volatility, makes a lot of sense. Now bear with me here because I am brand new to this whole document showing on the screen thing, and so I'm going to do my best. Bear with me. I hope that you can see this. So, does it pay to stay invested when the markets fall? I'll read this here to you because I really think that it says it perfectly. In stock market downturns, many investors are relieved to be on the sidelines. But then this worry often sets in. If I'm not invested, how do I reach my financial goals? Well, one way to answer the question is to look at what would happen if you simply ignored all the end of the world headlines and stayed invested. Clearly, given this example, you would have come out further ahead. In fact, even with 30 years of ups and downs, global stock markets have returned 9.3% annualized. This is as of January 2015, and that's with 3 major market downturns of as much as 51%. So what this document shows you is, if you invested your money in January 1985, you see this upswing here, and then you also see this Black Monday crash. So September to December 87. If you were invested in the stock market, you'd have a hit there of about 22%. I say hit only if you withdrew your money. If you didn't withdraw your money, you technically haven't lost anything yet because you have the opportunity for the market to recover. As you can see here, it did very, very well. So if you pulled your money out here, you would have experienced that loss. If you didn't, you would have experienced the uptake in growth and a fantastic return. Now we look at the tech meltdown in April 2000 to October 2005. That took a hit on the stock market of over 50%. But If you didn't pull your money out, you actually didn't assume that loss because you would have seen a full recovery here. And then in '08, which we all know too well, you would have had a downturn as well. But again, if you stayed invested, your recovery would have been really nice. And overall, even with these three major hits here, your overall rate of return would have been 9.3%. Now this is showing 85 to 2015. I actually have this huge index chart which goes back to 1934, and it doesn't just show the stock market. It actually shows every different type of investment, which is kind of great, like just bonds or just inflation or just Canadian stocks or just US stocks or a balanced portfolio. And what I'm saying is that it all tells you the same story. If you look at any short window of time, which then arguably if that's all that you have, you really shouldn't be invested in the market. But if you look at any short period of time, you will experience volatility. I mean, that's inevitable. And don't pull out, because if you give it any good period of time, say, 5 to 10 years plus, then yes, you'll still experience market volatility, but overall it shows time and time again, you will be in a great place. Now, let's talk about if you did try your hand during that period of time, 1985 to 2015 in the stock market, and you tried to, work that crystal ball and pull your money out and wait to see a little bit of growth and some hope and then put your money back in. So the top line here shows that if you put your 10,000 in and you left it in there the whole time and you never took it out, even through all those big crashes, your money would be at $153,000. If you took your money out and missed only the best 5 days in the market of recovery, so 5 nice days, and then you say, okay, I feel a little better, I'm going to put my money back in now. Well, you wouldn't have your $153,000. You'd have $93,000. If you missed the best 10 days because you wanted to wait a little bit longer just to make sure, your 10,000 would go 61,000, not 153,000. That's almost $100,000 less just for missing 10 good days in the market. Okay? Missing the best 30 days, you'd have only 18,000, and missing the best 50 days, you'd only have $7,500. So why am I telling you this? Well, I'm telling you this because we are in volatile times right now, and it is very easy to get scared and for our emotions to take over and want to cocoon and just retract. And I want to show you with a great visual, because I love learning visually, that is not your best bet. Your best bet is to be invested in a strong portfolio that is beautifully diversified across the globe, across sectors, across asset classes and industries, and has a great component of cushion there, of safe stuff, like government bonds and T-bills, to soften the blows so that you don't have quite as large swings as the stock market. If you have that in place, stay the course. Don't pull out, don't miss those best days in market, because one, if you pull out, you are going to take that loss, and two, you're not going to be able to see that great recovery of growth. If you have any questions, or if you like this video, please comment, or if you thought that it was really useful and you know that there are a lot of other people out there who are likely worrying, because let's face it, they really are, about market conditions, please share this video. I'd be happy to spread some sort of calm in all of this craziness, anxiety, and stress and worry, and I hope that you found some of that with this video. As always, if you need any help or you have any questions, please feel free to private message me, and I'd love to connect with you. Have a great day, everyone, and I'll be seeing you soon. Bye for now.